Welcome, everyone, to this explainer. If you're a focused learner gearing up for your ACCA financial management exam, you are exactly where you need to be today. We're looking right at Syllabus Area C1, focusing on Chapter 3, Investment Decisions. But we aren't just looking at dry numbers today. We're actually setting up what is arguably the most high-stakes battle in the entire realm of corporate cash management. We call it the fluid balance.
Okay, let's dive into our roadmap for today. We're going to cover the working capital lifeblood, the four core elements, the battle of liquidity versus profitability, the trap of overtrading, and finally, avoiding cash flow insolvency. Let's get right into it.
Section 1. The working capital lifeblood.
Look, working capital isn't just some abstract exam concept you need to memorize. It is literally the circulatory system of any surviving business. It represents the everyday funds you need to keep operations alive. Without it, the doors just don't open and the lights don't turn on. Basically, it's your immediate, accessible resource while you're waiting for those longer-term strategies to actually pay off.
Moving on to Section 2, the four core elements explained. Now, what's really interesting about this slide is how these four pillars actually interact to form the technical foundation of your ACCA FM exam prep. First up, we've got inventory. That's the physical goods you're holding, just waiting to sell. Second is accounts receivable. This is the money your customers owe you, but, well, they haven't actually paid yet. Third is cash, obviously the most liquid asset of all, sitting right there in your bank account. And finally, accounts payable, which is the money you owe out to your suppliers. These four elements, they're constantly moving, constantly interacting, and constantly demanding a financial manager's attention.
Section 3 brings us to a massive showdown: liquidity versus profitability.
And this brilliantly illustrates the ultimate tightrope walk every financial manager faces. On one side, you've got liquidity, which simply equals survival. You absolutely need cash on hand to pay your immediate bills. But on the other side, you've got profitability, which is your return. Think about it. If you leave all your cash sitting idly in a bank account just to be safe, it's not doing any work for you. It's not being invested back into the business to generate a return. So we're left with this fundamental conflict: hold cash to survive today or invest it to generate returns tomorrow.
This tension creates what we call the fluid balance. Holding too much cash kills returns, but holding too little absolutely kills the business. This is exactly the danger of losing your balance on that tightrope we just talked about. If you lean way too far toward profitability and tie up all your funds, you've got zero liquidity and boom, the business dies. But if you lean too far toward liquidity and just hoard cash, your investors get no return and the whole business stagnates. This right here is why active working capital management is so crucially important. It is a constant, daily balancing act.
All right, Section 4, the trap of overtrading.
So here's a question for you. Can a business literally grow itself to death? I know it sounds like a complete paradox, doesn't it? We're always taught that growth is good, right? That expansion is the ultimate goal. But when we're talking about Syllabus Area C1 and working capital management, the answer is a resounding and frankly terrifying yes.
And this brings us to overtrading. It happens when rapid business growth completely outstrips the available working capital to support it. Just imagine it. Sales are booming. Orders are flying in left and right. You're buying massive amounts of inventory just to keep up, and you're extending credit to all these brand new customers. Everything feels amazing. But suddenly, your cash is completely tied up in that inventory and those accounts receivable. The actual hard cash hasn't hit your bank account yet. You're growing so insanely fast that the chaos of unchecked growth is draining your resources way faster than you can replenish them. On paper, you look incredibly successful, but your bank account completely empty.
Which leads us to our final section, Section 5, avoiding cash flow insolvency.
So the crucial point is that cash flow insolvency is that terrifying moment a business falls completely off the tightrope. Listen, it really doesn't matter if your company is highly profitable on paper. It doesn't matter if you have the absolute best product in the world. If you cannot pay your immediate bills, we're talking your accounts payable, your payroll, your rent, simply because all your cash is tied up, you are cash flow insolvent. The game is over.
To summarize the core thesis of Syllabus Area C1, active management is a necessity. It's not an option. It is absolutely central to avoiding that trap of overtrading we just discussed. And mastering this fluid balance, that is your ultimate shield against cash flow insolvency. Whether you're just aiming to pass your ACCA exam or you're a real-world financial manager trying to keep the doors open, this delicate balance dictates the whole shebang.
I'll leave you with this final, rather provocative thought. Is your business sacrificing its survival for the illusion of profitability? It's absolutely a critical question for any focused learner to ask themselves when studying investment decisions. Mastering working capital, well, it isn't just financial theory, it is the fundamental art of staying alive in business. Thank you for joining me for this explainer, and definitely keep that fluid balance in mind as you continue your studies. See you next time.